Hey everyone, welcome back to Corporate Decoder, the place where we decode the hidden meanings behind corporate filings to see if these companies are actually making money or just talking a good game. Today we are diving into DaVita Incorporated. It sounds like DaVita has been busy refinancing some serious debt, and we are going to break down exactly what that means for you and me. Before we dive in, if you love getting straight answers from these complex financial documents, make sure to hit that subscribe button, and for even more insider discussions and to join our growing community, check out the Discord link in the description below. So, DaVita Incorporated, a big player in kidney care, has just filed a Form 8. Think of this as a current report that companies file when something significant happens that investors need to know about right away. In this case, it's all about a major financial agreement they've entered into. On the 24th of November, 2025, DaVita inked an 8th amendment to their credit agreement. Now, what is a credit agreement? Simply put, it's a fancy contract that outlines how a company borrows money, usually from banks. An amendment just means they are changing the terms of that existing contract. And the 8th Amendment tells us they've done this 7 times before, showing that managing their debt is an ongoing process. The big news here is they are reorganizing their debt. They've got a new 5-year loan facility called the new A Negative 2 Term Facility for up to $2 billion. They are using this to pay off their existing $1.95 billion term loan that was set to mature in April of 2028. Essentially, they are taking out a bigger, potentially better, timed loan to clear out an older one. But that's not all. They are also setting up a new revolving credit facility worth up to $1.5 billion. A revolving credit facility is like a credit card for a business. They can borrow money, pay it back, and borrow again up to a certain limit. This new one is also for 5 years and will replace their old $1.5 billion revolving credit line, which also matured in April of 2028. So, in a nutshell, DaVita is proactively managing its debt. They are replacing older loans with newer ones, essentially refinancing a significant chunk of their financial obligations. This suggests they are looking to optimize their interest costs, or perhaps secure more flexible terms as their business evolves. Companies do this to ensure they have access to capital while managing the cost of borrowing. Now let's talk about the cost of this new borrowing. They have options for how they want to pay interest. For loans in US dollars, they can choose between what is called the base rate plus something called the applicable margin, or a rate based on the secured overnight financing rate, more commonly known as SOFR. If you are not familiar with SOFR, it is a benchmark interest rate that has largely replaced LIBOR. The base rate itself is a bit of a mouthful. It's calculated based on a few different interest rates, including the federal funds rate, a prime lending rate from JPM, and that SOFR rate. It's designed to be a baseline interest rate that fluctuates with market conditions. Now, about paying back the principal on that $2 billion term loan. It begins to be paid down quarterly starting the 31st of March 2026. For the first 2 years, they will pay down 2.5% of the loan each year. Then, for the next 3 years, they will pay down 5% annually. Whatever is left will be due on the final maturity date. This structured repayment plan helps ensure the loan is gradually retired over its 5-year life. So, where is all this new money going? Primarily, it's going to pay off their old loans. That $1.95 billion term loan and the $1.5 billion revolving credit facility are being retired with the proceeds from these new facilities. Plus, they are covering fees and expenses related to this whole refinancing process. And importantly, any remaining funds can be used for working capital, general corporate purposes, which could include things like buying back their own stock, making acquisitions, or other investments. This shows they are not just refinancing debt, but also securing funds for future growth and shareholder returns. It's also worth noting that DaVita and its related companies might do other business with the banks providing these new loans. This is pretty common. Banks often want to offer a full suite of financial services to their big clients. Now let's look at the bigger picture and what this means. Refinancing debt isn't necessarily good or bad on its own. It is about the terms and the strategic reasoning behind it. DaVita is proactively managing its debt obligations. By securing new financing before their old loans mature, they are likely aiming to get better interest rates, extend their repayment timelines, or improve their overall financial flexibility. This is a sign that management is actively working to strengthen the company's financial foundation. In the world of corporate finance, especially for companies with significant debt like DaVita likely has, proactive debt management is key. It reduces the risk of facing a crisis when a large loan comes due and interest rates might be unfavorable. It can lower their interest expenses, which directly boosts their profitability. Remember, every dollar saved on interest is a dollar that can go towards growing the business, paying dividends, or reinvesting in operations. However, we need to keep our eyes open. Are they taking on more debt overall? Are the new interest rates truly better than what they had? While the filing doesn't give us a direct comparison of old versus new interest rate percentages, the focus on a leverage ratio based margin suggests they are aiming for efficiency. The fact that the margin narrows significantly for companies with lower leverage is a positive sign of good financial stewardship. What are the risks? Well, if DaVita's business performance declines significantly, they might struggle to meet the repayment schedules of these new loans, especially if interest rates were to rise unexpectedly. The kidney care industry is competitive and subject to regulatory changes which can impact revenue and profitability. But for now, this move appears designed to provide stability and financial breathing room. Looking at the broader context, DaVita is a major player in a critical healthcare sector. Kidney disease is a growing concern globally, so the demand for their services is likely to remain strong. Their ability to successfully manage their finances, like we see with this refinancing, is crucial for their long-term sustainability and ability to continue providing essential care. So, to wrap up our analysis of this particular filing, the 8th Amendment to DaVita's credit agreement shows the company is strategically managing its debt structure. They've secured new, potentially more favorable financing with clear repayment terms and interest rates that can adjust based on their financial performance. This is a move aimed at financial optimization and risk reduction. It appears to be a responsible step by management to ensure the company's financial health and operational continuity. Alright, that is our breakdown of DaVita Inc.'s latest filing. What is your take on these refinancing moves and what they signal for the company's future? Do you think they are setting themselves up for success or taking on unnecessary risk? Drop your thoughts in the comments below. If this analysis was valuable, hitting that like button really helps us out. And don't forget to subscribe for more deep dives into the corporate world. And again, for even more exclusive content and to chat with fellow finance enthusiasts, make sure you check out our Discord community linked in the description. Thanks for watching, and we'll see you next time on Corporate Decoder.